people know about negative gearing, but do you know how to leverage this strategy to build your wealth? Your investment property magazine editor Sarah Megginson sat down with Ed Chan from Chan & Naylor to uncover everything you need to know about positive gearing.
Negative gearing is where the outgoings of a property, the outgoings being things like water rates, council rates, repairs, are greater than, and plus the interest on the loan is greater than the rent that you're receiving. So there's a shortfall there, and generally most people need to fund that shortfall, and most people fund it from their wages, and you won't be able to keep or hang on to that property unless you fund this shortfall. No, the principal isn't tax deductible, and the reason why it's not tax deductible is that when you first receive the money from the bank, it's not taxed, so you don't pay tax on that principal when you first receive it. So therefore, when you pay the principal back, whether you pay it back in a lump sum or you pay it by a monthly amount, you can't claim that it's a tax deduction. You should always invest not for tax. Okay, so often, people say, "Oh, I'm saving tax on this, so I'll go and buy a property." That shouldn't be the reason why you invest. The reason that the tax refund is good is because it reduces the costs of holding the property, and the thinking behind it is that if I've got to pay, $1,000 a week in tax anyway, then if I go into a negatively geared property, instead of sending that $1,000 to the taxman, I can send the $1,000 to the bank to fund the interest on the loan, plus a bit more because there is a shortfall, and then it allows me to buy a property. However, it's not just the $1,000 in this example; it's quite a bit more than that. And unless you can have the means of funding that shortfall, then you shouldn't go into something just for the tax purposes. Often you'd wonder why people do buy negatively geared properties, because it can be quite risky, because if you're losing money on the property, often you're thinking, well, why would someone be happy to lose money on the property? Even though you might get a refund from the tax department, there is still a shortfall above that, and that refund minimises the losses. However, there's still a loss, and over many, many years it can accumulate. And the reason why a lot of people do it is because that the capital gain on the other side is hopefully more than the accumulated losses of the property over the lifetime of holding the property. And again, it's like all investments, Sarah. It's a risk. And however, in real estate, it's a lot safer because there is a history of growth in real estate, and it's a lot more reliable than any other sort of investments. Okay, depreciation is a really good thing. However, since 2017, it's been watered down by the government, and there's two types of depreciation. There's depreciation on plant and equipment, things like your carpet, your light fittings, your curtains, and that has a higher depreciation rate. And then there's building allowance, which is on the building itself, and that's got a lower depreciation rate, generally around 2.5%, and over 40 years. Whereas the fixtures and fittings depreciation rates are higher, so you can fully depreciate that in a shorter period of time. So depreciation is a bit like allowing you to claim only a portion of that for an extended period of time, rather than being able to claim all of it at the same time. It allows you to spread it out over a longer period of time. Now, on the flip side of that is that when you come to sell the property, then the building allowance that you've been claiming comes back in as an assessable capital gain. And I can explain capital gain in the sense that the reason why people buy property is for the capital gain, and if you then sold the property later on, then the difference between what you bought it for and what you sell it for, less all the costs off in between, is then that's subject to tax. And the tax is called capital gains tax, but it's not a set fixed amount. The capital gains tax rate that you pay is what your personal tax rate is. So if you're on a 20% tax rate, then the capital gains tax is calculated at 20%. But if you're on a 47% tax rate, then it's calculated at 47%. So it is your personal tax rate that will determine how much you pay on the capital gains side.